Good morning. After completing admission of a partner, the next work we have to do is retirement of a partner. So, retirement of a partner takes place when a partner wants to retire from the business on account of his old age or ill health or inability to work anymore or difference of opinion with the other partners or even for better business opportunity he may leave. So, these are the possible reasons why a partner will retire. Now, when a partner will retire, that will be governed by section 32 subsection 1 of Indian Partnership Act. A partner can retire from the partnership firm in any of the following three ways. First of all, expressed or implied consent of all the partners, express agreement by the partners, or at the time of or in case of partnership at will, just by giving a notice to all the partners, a written notice of course, then the partner can retire. Now, whenever a partner retires, the partnership dissolves. I am talking about the dissolution of the partnership, not dissolution of the partnership firm. So, the partnership will be dissolved, means the agreement will come to an end, a new partnership will again start, but the same business will continue. And whatever amount is that is regarding the dues of the retiring partner, that will have to be given to him. Either it will be given to him or it will be converted to a loan, that we will discuss in detail. Now, coming to the profit sharing ratio, what are the problems we will deal with? One is profit sharing ratio, another is treatment of goodwill, then revaluation of assets and liabilities, then distribution of undistributed profits or accumulated profits and losses, then retiring partner's share of profits up to the date of retirement, then life policy, total amount due to the retiring partner, then settlement of his account, then adjustment of capital according to the new profit sharing ratio after the retirement of the partner, outgoing partner. So, these are the things which we will discuss, and on the basis of that, on the principles which we will discuss now, we will have to prepare a problem on account of the retirement of a partner. So, coming to the profit sharing ratio, suppose the old ratio between A, B, C was 3:2:1. Now, if B wants to retire and nothing has been given, then the new partners, that is the continuing partners A and C will share profits and losses in the ratio of 3:1. And what will be the gaining ratio? The gaining ratio also will be 3:1 in the absence of any specific instructions. But if it is given, suppose the new ratio between A and C will be 2:2, suppose, or we can say equal 1:1, then we can find out the gaining ratio. What is a gaining ratio? A gaining ratio is the difference between new ratio minus old ratio. In this case, A will be having 1/2. Let us make it changed, suppose 2:1, suppose it will be. So, it will be new ratio is 2/3 and his old ratio was 3/6. And for B, it is now 1/3 minus 1/6. So, in this way, whatever we will get is the gaining ratio. 6 means it will be 6, 2, 4 minus 3, that is 1 by 6, and here it will be also 6, 3, 2 minus 1, that is 1 by 6. That means, the gaining ratio is 1:1, 1 by 6 is to 1 by 6 or 1:1 or equal gaining ratio. So, in this way we can find out the gaining ratio. So, that is the only thing we have to know regarding this profit sharing ratio. Then we will come to treatment of goodwill. Para 36 of AS 10 states that goodwill should be recorded in the books only when some consideration in money or money's worth has been paid. Otherwise, goodwill cannot be recorded. So, that means only purchased goodwill will be taken into consideration and not generated goodwill. So, the effects is only purchased goodwill can be recorded, and number 2 is non-purchased goodwill, that is internally generated goodwill, will be adjusted through partners' capital accounts and under no circumstances should be shown in the balance sheet. That means, for the adjustment of goodwill, that is on the retirement of a partner, you cannot raise goodwill. Whatever goodwill is there, that will have to be written off if you raise it. That means, goodwill account which will be coming in the event of retirement of a partner will have to be written off immediately or will be adjusted through the capital accounts directly. It will not appear in the balance sheet because it is not a purchased goodwill, it is a generated goodwill. So, the treatment will be a retiring partner is entitled to his share of goodwill, and therefore, he will have to be that means, if there is existing goodwill, that goodwill will have to be written off. By writing of goodwill account, we can write all partners capital account debited. Suppose 30,000 goodwill was there, all partners capital account debited to goodwill account in the old ratio. In this particular issue example which we have taken, if the goodwill is 30,000 and the old profit sharing ratio among A, B, C was 3:2:1, then first of all we have to write off this goodwill. How? We will be writing this entry: A's capital account debited, B's capital account debited, C's capital account debited. B is retiring, but his capital account will be debited. In the ratio 3:2:1, 30,000, so it will be 15,000, 10,000 and 5,000 to goodwill account 30,000. So, this will be the entry: A's capital account debited, B's capital account debited, C's capital account debited to goodwill account. So, in addition to that, the adjustment of goodwill by valuing the retiring partner's share of goodwill, the retiring partner's capital account should be credited because he should be entitled, he should get his share of goodwill. So, his capital account will be credited and the continuing partners accounts will be debited. That will be debited in which ratio? That will be debited in gaining ratio. So, in this example, if we continue the example, then if the new profit sharing ratio, when B goes away, the new profit sharing ratio suppose is 2:1, then how it will be done? So, here the gaining ratio we have to find out, and gaining ratio we have already calculated, that is 2 by 3 minus 3 by 6, that is 1 by 6, that is for A, and for C it was 1 by 3 minus 1 by 6, that is equal to also 1 by 6 or 2 by 6. So, 2 minus 1 by 6. So, it is equal. Now, out of 30,000 actually B is entitled to get 2 by 6. B's share is equal to 2 by 6 of 30,000, that is equal to 10,000. For these 10,000 we can adjust in the profit sharing ratio like this. Here what we can do is we can write first of all goodwill account debited, raise goodwill and write it off. While raising it will be in the old ratio, and while writing off, because we cannot keep it in the balance sheet, we have to write it off, and it will be write off to the it will be written off to the accounts of the continuing partners in the new ratio. Either we have to do this, or another alternative is only his share, that is outgoing partner share we can take, and that will be goodwill account. For this what we will do, this is one way. Another way is we can only calculate his share. His share is 10,000. So, the entry will be goodwill account debited 10,000 to his capital account, that is to B's capital account. This will be the first entry, and the second entry will be continuing partners capital account, that is A's capital account debited, C's capital account debited to goodwill account 10,000, in which ratio? In the gaining ratio. And what is the gaining ratio? Equal. So, we can take it 5,000, 5,000. This is second procedure. The third procedure is nothing but the combination of these two. Here goodwill account is credited 10,000, goodwill account is debited 10,000. Leave that, simply it will be adjusted through the capital accounts of the partners. So, B should get a credit of 10,000, A and C in the gaining ratio will be debited. So, the entry will be A's capital account debited 5,000, B's capital account debited, sorry, C's capital account debited, because B is outgoing partner, debited 5,000 to B's capital account 10,000. This way is the simplest way, or you can say this shortest way, we can do that also. But whatever may be the way in which you are going to pass the journal entries for this goodwill or for the treatment of goodwill, the effect will be the same. Always the effect in all the three cases will be the same. Goodwill account will not be shown in the balance sheet. Now, we will be coming to the revaluation of assets and liabilities. So, the revaluation procedure is same. We have to prepare one revaluation account and reduce the value of assets and liabilities or increase the value of assets and liabilities as per the instructions, and only thing is the distribution will have to be again made in the old profit sharing ratio. Now, it is true up to that, correct. Similarly, suppose there are 3 partners, now there will be 2 partners. If you prepare a memorandum revaluation account, now it will be distributed among the remaining 2. But in the admission case it was 2 and 3, but now it will be 3 and 2. So, it is all the same, exactly the same in the manner in which we have already done in case of admission of a partner in the old ratio and in the new ratio as it was there. If there will be a memorandum revaluation account, it will be in the new ratio, and in case of retirement in the new ratio there will be only 2 left or less number of partners will be there. So, that will be distributed among them. So, there is absolutely no difference between the two. So, also in case of undistributed profits and losses. So, undistributed profits or losses, or you can say accumulated profits and losses, will have to be shared in the old profit sharing ratio in the event of retirement of partners. So, there is nothing new it. If there is a profit, accumulated profit, that will have to be distributed among A, B, C in their old profit sharing ratio. That profit and loss account credit balance will be debited. So, that will come to 0, or reserve fund account debited, or general reserve account debited to partners capital account. In this way, all the partners including the outgoing partner will be credited in their profit sharing ratio, that is the old profit sharing ratio. Similarly, if there is accumulated losses, that loss account will have to be created, and these partners capital account will be debited in the old profit sharing ratio. So, this is also exactly the same, just like in case of your admission of a partner. Then retiring partner share of profits up to the date of retirement. Usually the retirement takes place at the beginning of the year or at the end of the year. So, there should not be any difficulty in calculation of this. However, if the retirement is within the or during the year, then we have to calculate, because the profit must not have been calculated so far. Profit will be calculated only by preparing the profit and loss account at the end of the year. Therefore, what we will have to do is, we have to take or estimate some profit, expect some profit. That profit may be on the basis of last year's profit or last so many years average profit. Like this we can determine, and his share of profit, for his share of profit we will have to pass one entry. His capital account will be debited. Suppose B is going out, B's capital account will be credited, and profit and loss suspense account will be debited. Only his share. For his share of profit out of the expected profit, profit and loss suspense account debited to B's account. If B is going out, or B is the outgoing partner, to B's account, that much. And this profit and loss suspense account, because it is showing a debit balance, it will go to the asset side of the balance sheet until and unless it is written up, that is at the end of the year. At the end of the year, when the profit and loss appropriation account will be prepared, that account will be debited and this account will be created. So, in that case, at the end of the year, PL PL appropriation account debited to PL suspense account. In this way, PL suspense account will be cancelled and it will affect the appropriation of profit, that is profit and loss appropriation account. Then coming to the life policy. Number 6 is life policy. Life policy may be individual life policy or joint life policy. In case individual, several life policies have been taken in the name of A, B and C. Suppose in the name of A it was 20,000, in the name of B another policy has been taken for 50,000, and in the name of C another 30,000. So, in this way total is 1 lakh. So, when B goes away, he will claim not only his share of the life policy, but also the shares of others, because that has got to be distributed in the same old ratio. So, what we will have to do is, we have to take the surrender values of all these policies. Suppose the surrender value is 2,000, 8,000 and 10,000. So, total is coming to 20,000 on that date, that means if you surrender, actually it will not be surrendered, but if it will be surrendered, then this 20,000 rupees will be received from the insurance company, and in that 20,000 what is his share, we can give him. So, his capital account will be credited and life policy account debited. Life policy or insurance policy account debited to B's capital account with his share. His share is 3:2:1, so 2/6. So, into 2/6, 20,000 into 1/3, that will be coming to 6,667. So, he gets a credit, his work is over. Then coming to the joint life policy, if there is a joint life policy, the same thing will happen, because he is not dying, so that the total policy amount cannot be recovered. So, in case of a joint life policy, when the premium is paid from the partnership firm, then in that case what will happen? Joint life policy is taken for suppose 1 lakh, that is in the joint name of ABC. Now, when B retires, he wants to take a share out of it. So, the surrender value will have to be determined. Suppose the surrender value is 60,000. Now, give him 2/6 of 60,000, because the profit sharing ratio is 3:2:1, and this fellow is going out 2/6. 60,000 into 2/6 is equal to 20,000. So, his capital account will be credited and joint life policy account will be debited with 20,000. So, what will be the total amount due to the retiring partner? Actually, he will be getting his capital plus profit up to the date of retirement, then interest, salary, commission, whatever is payable to him, then his share of profit on revaluation. If there is loss on revaluation, it will be deducted, otherwise it will be added to his capital account. Then if there is any accumulated profits or undistributed profits, his share of accumulated profits also he will be entitled to take, his share of goodwill, his share of life policies. For these things he will be credited. Now, he will be debited for what? If he has made some drawings or there is interest on drawings, for that his capital account will be debited. Loss on revaluation, if any, will be debited to his capital account, and then if there is accumulated losses, his capital account will be debited. So, from the total of the credit, we deduct the total of the debit, and whatever amount is due, that is the amount we have to give to him. Now, when he will be taking the cash, that amount will be retiring partner's capital account debited to cash account. If suppose it will be converted to say 8% loan account, he will be getting 8% loan, I mean instead of getting cash, suppose his capital account will be converted to his loan account. So, he becomes our creditor henceforth, and his name will be appearing as a loan in the balance sheet, and there we can transfer it, retiring partner's capital account debited to partner's loan account, or sorry, B's loan account. Like this we can do. So, this way either by giving cash or by transferring it to the loan account, we can settle his account. Then the last point is regarding the number 8 is settlement of account. And number 9, that is either loan or cash. Then number 9 is adjustment of capital among the remaining partners in the new profit sharing ratio, that we have already done in the admission case, and here also we can do that along with a problem. So, now let us take one problem on this retirement. So, this is a question. We will be preparing capital accounts, revaluation account and partners loan account. Suppose there are 3 partners A, B, C, we can prepare this capital account, then we can prepare one revaluation account. Then one balance sheet also we can prepare. Here is the problem. A, B and C are partners sharing profits and losses in the ratio of 2/5, 3/10 and 3/10. That means 4:3:3. The ratio is 4/10, 3/10 and 3/10. 4:3:3. Their balance sheet as on 31st December 2014 was as follows: capital account 16,000, 12,000 and 10,000. So, by balance brought down, (16, 12 and 10). Then reserve was 5,000. When there is reserve, naturally we have to distribute it immediately. By reserves, what is the total amount of reserve? 5,000. So, 5,000 divided by 10 is equal to 500. So, it will be 5,000 into 4, that is 2,000 into 3. After distributing the reserves, let us take the bills payable and creditors to the balance sheet directly, because there will be no effect of any changes. Then building 18,000, plant 14,000, motor car 4,000, stock 10,000, debtors having less provision, cash at bank. It is there. B retires on that date on the terms that the goodwill of the firm is to be valued at rupees 7,000. There was no goodwill. So, when goodwill will be valued, we can adjust through their capital accounts. So, what is their profit sharing ratio? Let us see first of all, because without the gaining ratio we cannot distribute it. Okay. Stock and buildings are to be appreciated by 10%, plant and motor car are to be depreciated by 10%, liability for the payment of gratuity to workers 2,000 is not yet recorded in the books, but the same is to be provided for. Provision for bad debts is no longer necessary. It is decided not to maintain goodwill account in the books. Naturally, what we are going to do is the goodwill will not come to picture. The amount payable to B is to be paid in 3 equal installments, or it will be converted to a loan account having 10% interest. You are required to prepare revaluation account, partners capital account, new balance sheet as on 1st January 2015. So, here what we have to do is, there is no mention regarding the new profit sharing ratio. So, when the profit sharing ratio was 4:3:3 and one partner, that is B, retires, then the new profit sharing ratio will be 4:3 between A and C, and also that goodwill will have to be accordingly treated, and the sacrifice or the gaining ratio will be the same, 4:3. So, now there should not be any difficulty. Let me pass the entry for the goodwill. If the total goodwill is 7,000, first let us calculate what is his share of goodwill, that is outgoings partner share of goodwill. Partners cap will be 3/10. So, it comes to 2,100. 7,000 is the total value of goodwill, and B, who is retiring, his share was 3/10. So, 7,000 into 3/10 is equal to 2,100. Out of 2,100, what will be the entry? The entry will be, his capital account will be credited, B's capital account will be credited, and A's capital account debited, C's capital account debited in the gaining ratio to B's capital account 2,100. So, what is the gaining ratio? 4:3. 4:3 means 7. So, it will be 4 by 7, 4 by 7 and it will be 3 by 7. So, when we divide 2100 by 7, it is coming to 300. So, 1200 and 900. So, the entry stands like this: S capital account debited, C's capital account debited to B. S capital account and C's capital account debited to B's capital account 1200 and 900. This is towards goodwill. After the treatment of goodwill, let us come to the next adjustment, that is stock and building are to be appreciated by 10%. We have already taken the reserves, how the accumulated profits has been there. Then coming to the revaluation of stock, stock was 10,000 and building was 18,000. So, we have to write off 10%, that is 1,800 from building and 1,000 from the stock. So, it is a it is appreciated. Stock and buildings are to be appreciated. So, there is a profit. So, revaluation account is getting credited by that. Then plant and motor car are to be depreciated by 10%. Plant is having 14,000. So, 2 plant 1,400, it will be reduced, decrease in the value of the asset. Plant and motor car is having 4,000. So, 400 rupees will be written off, that is the loss on revaluation to car, motor car. Then liability for the payment of gratuity to workers 2,000 is not yet recorded in the books, but the same is to be provided for. So, when 2,000 rupees is there, there is an increase in the value of a liability, it is a liability. We have to make a provision. Previously, this provision was not there. We have to make a provision out of the profit. So, profit is going to be reduced, or we can say there is increase in the value of a liability. So, when there is increase in the value of a liability, it will be a loss. So, we can write to provision for gratuity. That is 2,000. Provision for bad debt is no longer necessary. That means provision was reduced from the debtors, from 7,000, 1,000 was reduced. So, it was 6,000, but now there is no need for provision for doubtful debts. So, 7,000 out of 7,000 will receive. That means there is a profit of 1,000, or we can say decrease in the value of the provision for doubtful debts. So, by provision for doubtful debts 1,000. It is decided not to maintain goodwill account in the books, that we have already treated here through the goodwill, how it has been adjusted through the capital account. So, there is no need to be worried about that. Then the amount due to the partner B will be settled by converting it to a loan of 10%, 10% loan account. That will do. When we will find out what is the ultimate balance due to B, that will be converted to B's loan account. Okay. Now, let us close the revaluation account first. This side it is coming to 3,800, this side it is also coming to 3,800. That means there is neither profit nor loss. So, nothing will come to by revaluation or to revaluation, because there is no profit or no loss on revaluation. However, this will be affected in the balance sheet. We will come to that. Now, we have to close the accounts of capital accounts of A, B, C. The amount payable to B is to be converted, A retires on that date, I have taken this one, that is A's capital account debited, C's capital account debited to B, but B's capital account should be credited by A towards goodwill 1200 and by C towards goodwill 900, 11,500 here, $900 is there. So, two balance carried down and buy balance brought down. It is 11,500. So, the difference is 10,600. So, buy balance brought down 10,600. B $15,600. This 15,600 is not going to be balance carried down, rather this amount will be converted to his loan account, B's loan account. That is 10% loan, it will be converted to 15,600. Then we have got A's capital account, it is 16 plus 2, 18,000. 18,000 minus 1,200 is 16,800. 16,800. This we can show in the balance sheet liability side. Capital account of A 16,800 and capital account of C will be 10,600 and B's loan account 15,600. B's loan account. Then coming to the asset and liability, other liabilities, we will see what can be done. So, first of all, coming to building, it was 18,000. Now, building has been appreciated by 1,800, that means it is coming to 19,800. So far as the building is concerned, it is coming to 19,800. Then plant 14,000, it has been decreased by 1,400. So, plant 14,000 minus 1,400, so 12,600. After plant, motor car 4,000 minus 400, so 3,600. After motor car, we will come to stock. It was 10,000, but with an increase of 1,000, it will be 11,000. Then coming to debtors, it will be 7,000, nothing will be deducted. $7,000. Then cash at bank 1,000 was there, now cash at bank we have not touched, so that will be there, bank 1,000. Then coming to this provision for gratuity, that will be a liability. $2,000. So, we have taken everything into consideration. Now, let us make the total and the balance sheet should be equal. We have taken A and C's capital account, that is 16,800 and 10,600. Then we have taken B's loan account 15,600, bills payable 2,000, creditors 8,000 and provision for gratuity 2,000. So, total will be $55,000 this side. Let us see what is the total of this side. it is also 55,000. In this way the problem will be okay, and we have already solved the problem on retirement of a partner. So, this is all regarding the retirement of a partner. Thank you.